In 2016, Rajat Mehta backed an early-stage online investment platform called Grow, a startup he says was valued at just 1.3 million US dollars at the time. Fast forward to November 2025, when Grow made its market debut on India's stock exchange at a valuation of 8.6 billion. For the 30-something heir to the Mumbai-based Mehta Group, it wasn't just a winning bet. It was a sign that India's wealth is starting to move differently.
So historically, Indian families used to hold their wealth in gold or land assets. And now this money is actually coming out and being invested back into the economy through a lot of these startups.
The new age, the new generation is coming on with ideas, and they just need somebody who can mentor them and help them with better execution of those ideas. The old age firms who have built over the last 2.5, 3 decades, that family office has looked at investments who have started conservatively, have now looked at being much more aggressive in the market.
This shift isn't being driven by India's legacy families alone. It's also being shaped by first-generation founders who built their fortunes over the past 3 decades, and a fast-growing new rich class.
It's about reallocating capital in the economy. But now they are thinking about investing in financial assets and startups and tech and biotech and other sectors that didn't even exist 10 years ago. To me, that's a structural change in the economy.
According to the 2025 Hurun Global Rich List, India is home to 284 billionaires, up from 271 a year earlier, ranking third globally behind the US and China.
Within that growing pool of wealth, India is on a cusp of an unprecedented intergenerational wealth transfer of $1.5 trillion. And at the same time, India's ultra-high net worth population is expanding rapidly. These are families or individuals that have assets over 30 million. This number has increased to 13,000 and is estimated to grow to about 19,000 by 2028.
For generations, India's biggest business empires have followed a familiar pattern. A founder builds the company, the family retains control, and the next generation takes over.
If there's one family that defines India's wealth, it's the Ambanis. Mukesh Ambani is Asia's richest man, and his succession planning involves transferring the leadership of his $250 billion empire to his 3 children, Akash, Isha, and Anand. The Ambani family has diversified from its oil and gas business into retail, digital, telecommunications, and new age energy. So another example is the Adani business empire, which has interest across ports, airports, and energy. Gautam Adani has already made plans to transfer the control of his empire to the next generation by 2030. But not every succession story is well planned or smooth.
Across Asia, succession is more fragile than in the West. Much of today's wealth was created quickly, and many affluent families are still only in their first or second generation. A 2025 study highlights the gap. Among the 46 family business founders surveyed, 91% said they intended for leadership to stay within the family. Yet, 28% of founders cited a lack of interest from the next generation. And even among the 72% who have identified a child as a potential successor, 24% said that successor is underprepared. That matters because family-owned businesses still account for about 79% of India's GDP, one of the highest ratios globally.
The governance risk is there. If the capital is misallocated or creates asset bubbles, that's what we should worry about. These kind of disputes are well known around the world where heirs take over the company, they have different visions, different ideas. I mean, these things have macro implications. If one of the heir takes over and it doesn't really go the long way because lots of investment is happening of private and public capital in these companies. So when they fail, they can actually create major disruptions for the economy.
Indian family offices are shifting from passive income to hands-on private equity-style investing. And increasingly, next-generation heirs are backing startups that build on their family's core industries.
When you invest in a business which is more like an affiliate to your own business or is correlated to your own business, you know how the ecosystem works. So wherever the understanding of business is high, the money comes in at a very early stage of investment because your risk reward is potentially the highest. You have a higher percentage of making that a success.
But India's startup capital isn't coming only from inheritance. India opened its economy in 1991, rolling back decades of state controls and protectionist policies. The reforms helped trigger a wave of private enterprise and, over time, the rise of a large cohort of self-made Indian billionaires.
Indian social fabric changed in last 2.5 decades is where that generation became much more confident with access to information. They went through the phase when India was on a growth phase. They built something new. Now, once they have built it, they understand the nuances of the new age requirement. Now they have built enough capital for themselves to not look at new ideation, but to look at new ideas where they can support. They can then help them with the kind of learnings that they have gone through, help them reduce the kind of risk, or you can shorten the path to success.
Alongside them is a fast-growing new rich class, startup employees who've minted wealth through employee stock ownership plans, stock options that can become highly valuable when a startup goes public or is acquired.
The emergence of Flipkart was because there was a democratization of ESOPs. This was a new age ESOP wealth creating firm, which apart from its promoters, the large number of millionaires were created. They believe that network can help the business grow. New companies have emerged and have gone on to become sizably large market cap firms.
In 2025, 12 startups executed ESOP buyback schemes, providing more than 158 million in payouts to 9,265 employees. So, how is all this wealth, old and new, actually being managed? In just 6 years, the number of family offices in India has jumped from 45 to 300, together overseeing about 30 billion in assets. Many Indian family offices now allocate over 10% of their portfolios to private equity and venture capital, with some exceeding 20%.
Now, it is much more structured, well thought out, well planned. The policies are well defined. It is just not money being kept aside for investment. The governance is playing a significant role and it is acting as a risk mitigator. There's an absolute clarity of approach. Which segment that they want to go under, what percentage of allocation has been made for that specific sector, how much is going to listed, how much is going to debt, how much is going to the unlisted space, early stage, the mid stage, pre-IPO.
But this generation isn't just trying to preserve wealth, they're trying to grow it. After a funding boom in 2021 and 2022, global investors pulled back. Startup funding in India fell sharply from 25.7 billion in 2022 to 9.6 billion in 2023. Amid higher interest rates and weaker public markets. After the boom cooled, Indian startups had to look closer to home, and by then, a new pool of domestic capital was ready to step in.
Back in 2024, quick commerce startup Zepto wanted to raise about $300 million, but after an overwhelming response from family offices, ended up raising $350 million in 4 weeks. This round was largely led by Indian family offices, which were managed by Motilal Oswal, which is a private wealth management firm in India, and other individual family offices like that of Rajat Mehta.
In the startup also, they know that where is a risk, right? They also understand that if they make 10 investments, there are chances that 1 or 2 can go through difficult times. But can their better ones cover up for this downside? The key is, how do you create your allocation?
India's startup boom was once driven largely by foreign capital. Today, more of that money is coming from within. Capital that once sat in gold vaults and family estates is now flowing into technology, renewable energy, healthcare, and infrastructure.
If we create more domestic capital that is invested, it means you're relying less on foreign capital, which means you can invest for longer periods and take more risk as a company because your cost of capital is lower. Interest rates are typically high. But if the money is domestically generated, then the volatility is low for the banks, so they provide it at a lower interest rate. And so their ability to generate revenue or generate profits on their ideas higher. That allows you to take extra risk, allows you to experiment slightly more, and then successfully take the company public, create unicorns, take companies to IPO, and essentially benefit the entire ecosystem and the macroeconomy.
The question is whether this capital can build resilient businesses, deeper markets, and long-term growth, or will it just fuel the next cycle of risk? If not managed well, it could destabilize markets, and the consequences won't just stay contained within India.